Welcome to this webinar. I hope you can see me and I hope you can see my presentation on the screen. It's a new format for us. It feels a little bit weird because I am sitting in front of a computer screen. I can't see anybody else, and it feels as if I am actually now going a little bit mad. So I hope your lockdown is going well. The Omanis are well. My wife will be qualifying for the Garden Olympics after this. And I'm not sure we're going to have any grass left by the time this lockdown actually ends. But it looks as if she will qualify and probably medal at this point. My 15-year-old son I was feeling sorry for him the other day. And then I realized that he wasn't in contact with any of his mates, and then you see him on Xbox with his microphone and his headphones playing with his friends who are all sitting at home. So we're all making do, and I hope you guys are as well. Just to give you a little bit of background, just on the Veritas team, everybody is fine, everybody is working from home, and it's actually working out remarkably well for us. We're quite functional working remotely because all of the stuff that we use is in the cloud. And actually one of the projects that we wanted to do in our business was to actually use paper less. And now we are forced to actually do that because all the files remain at the office. The other thing that's happened is over the last year, many of the service providers, the asset management companies, are actually doing transactions electronically. So we are actually able. Some are better than others, but we haven't come across any transaction that we've not been able to do since the lockdown, which has been great. We're staying in touch with each other through Zoom. We have a meeting with all of us every second day, and the planners probably meet every day. It is quite interesting to see both Laura and Heidi have got very young families. And so while mum is on the screen with us, we're all watching the 4-year-olds and the 3-year-olds doing flick-flacks on the couches behind them, which is quite entertaining. And when you get off the screen, you kind of go, well, lockdown wasn't great, but at least my kids aren't that age anymore. So I want to take you back. So the other thing that we have been doing over the last few weeks is that we've been listening in on many webinars ourselves. So we've been exposed to probably 3 of the best economists in the country. We've listened to offshore managers. We've listened to local managers. We're in touch with Fundhouse probably on a daily basis because the movements in the market have been so huge. And we just thought, with all the events that have taken place, and they've been quite dramatic events and movements, we thought that we would take a moment to try and distill a lot of this information that we've actually been given and give you a little bit of a feedback and a little bit of a sense as to what has happened and where things are at the moment. So I want to take you back to January the 1st. This year feels like an age ago now, but it's only just over 3 months ago. And if you remember back then, we were worried about rolling blackouts. We were worried about SOEs. We were worried that the country would go into recession. And we were worried and fairly sure that the country was going to get downgraded by Moody's. And then this was a graph that we were looking at in January, and it's produced by Fundhouse. And what it does is that these are all the choices we have to invest our clients' money over here. And then what we want to do is, as people come with new money to us, we try and work, and existing money, we're trying to work out, is the market priced properly? Where is the market at the moment? And how are these different choices, how are they priced right now? So where I have the cursor now is 0. And 0 means that this particular choice of asset is well priced and will give us the expected return that we would expect from that asset class over time. When we move to the right, it means that it is actually expensive. It's starting to get expensive It's getting very expensive, and it's getting into kind of bubble territory over here. So when you buy something when it is over here, you can't expect a great return over the next 10 years from that. The reverse of that is when something is over to the left and in a negative figure, that means that it is cheap. And when you can buy an asset when it is over here, over the next 10 years, you would expect a much better return from it. So let's go through what the world looked like on January the 1st, 2020. South African equity and the bond market were equally priced, slightly expensive, but not, it was still a buy at that point. South African property was negative, but we actually felt there was actually more bad news to come in that, and it wasn't all the bad news wasn't in the price of that just yet. Down here in global developed markets are the equity markets or the share markets all around the world in dollars. And they looked slightly expensive, but not too scary. And how this bar is built is with these 4 bars here primarily. And the biggest one is the American one. And it looked as if America at this point was quite expensive. And it was actually worrying us at that point. It actually went on after that for the next 6 weeks to go even higher. So America looked expensive. Britain looked priced, well priced for the next 10 years. European equities looked relatively cheap, and Japanese equities looked even cheaper. Interestingly enough, this figure was the one that interests us because it was emerging markets, and emerging markets were looking quite cheap at that time. And South Africa is an emerging market, and that would be a major driver going forward of growth. So if money could be allocated to emerging markets, South Africa would benefit from that. And then down here, global property looked pretty expensive. And then the things that looked incredibly expensive are the G7 developed markets, bond markets. And they looked, which are very defensive asset classes, but they looked extremely expensive. And then emerging market bonds also looked expensive at that time. And then, so the markets took off, and actually all markets went up for a few weeks, around 6 weeks. And then word around the 19th of February came out that the coronavirus, which was yet another Asian virus, that the stock markets hadn't really priced in. And it arrived in Italy. And I think around that date, the first people started dying in Italy from the virus. And the markets got a hell of a fright and started to sell off quite quickly. Now, what you're looking at here are the first 30 days of this crisis are here. And you see all of these lines are all different types of asset classes and how heavily they've all sold off. And you'll see the South African share market is the red line, and it actually went down 35% within 3 weeks, which was a dramatic sell-off. What that is compared to is for the first 100 days of the 2008-2009, or the global financial crisis as it's called, which was the second worst stock market crash in the history. And it was just comparing, and what it's showing is just how dramatic and how aggressively markets were sold off in that time. There has been a pullback since then, which we'll talk about a little bit later. So dramatic sell-off, real panic stuff. Even the most defensive asset classes gave you a negative return. Gold gave you a negative return in this period. Government bonds gave you a negative return in this period. It's quite extraordinary panic selling. Now, a lot of people listening to this webinar won't know a huge amount about shares or equities or how they work. Less people will know about the bond market and how the bond market works. But 98% of people listening to this will understand residential property. So I thought I'd put together a little analogy for you. So imagine this house is in Cape Town, and it is one of 5 identical houses in a closed estate in Cape Town. And 3 years ago, you got a note in your box to say that the agent thinks your house is worth 11 million rand. In January 2019, one of your neighbors living in number 1 sold his property for 10 million rand. He wanted to move into a retirement village. So you thought, well, it was worth 11, now worth 10. Okay, the market is a little bit soft at the moment. A few months later, in September, you bump into the guy who lives in number 3. And he says, no, he's going to move to Australia and he has to be there by the 1st of April 2020. So he puts his property on the market on the 1st of October at 10 million rand. And nobody comes to see his house. A month later, he drops it down to 9. A couple of people come and look, but no serious buyers. By December, he started to move it down to 8 million rand because he needed to get the money out and he was getting a bit worried about the rand. By the new year, he was now getting very nervous. And by the 20th of February, when all stock markets and all asset prices started to come down, he was petrified. He was petrified for his own health, his family's health. He was petrified because the rand was weakening. He was petrified that all asset prices and there was no buyer. And somebody put in a cheeky offer at 6.5 million rand, and he took it. Now you got word that this house was sold for 6.5 million rand. Now every bone in your body tells you that this house is not worth 6.5 million rand. Okay, it might not be worth 10 at the moment, but it's definitely not worth 6.5. And maybe at the worst, you might sell your house for 8.5 if you were desperate, and maybe 8 if you're incredibly desperate. But this is a very good picture of how asset managers think, because now imagine that a bunch of asset managers jump out of a car all dressed in suits and start looking at and standing outside this house that is sold for 6.5 million rand. And they meet you and they say to you, would you sell your house to us for 6.5 million rand? And then they hop back in their car and they're telling you they're going to the neighborhood next door and they're going to see if they can find any distressed sellers in a better neighborhood that would sell their house to them even cheaper. So what you're seeing here is that is how asset managers get energized in these moments, because these are the moments that if they can pick up properties from distressed sellers now, they will give them their performance for the next 10 years. So to summarize that story, in times like this, money moves from weak hands to strong hands, and we must make sure that we don't fall into that trap. So what did happen asset prices in that time? If I point out the green line here down at the bottom, the green line is SA property stocks like Growthpoint, Redefine, companies like that are in here. And basically that has lost 50% now, which is basically pricing in bankruptcy for some of these companies. The purple line is the JSE, and the JSE has come down to 35%, but you can actually see that it's bounced back, and this is to the end of March, and it's gone up even further since then. The red line up here is offshore equities, but it's offshore equities in rands. So the rand has depreciated. Offshore equities come off by 30% as well, but the rand depreciation has protected the losses from that. And you'll see that a little bit clearer later on. So just to give you a sense of that, so at its worst, the JSE went down minus 35%, and at its worst, the MSCI index went down minus 30% in dollars. So where was the market at the end of the month, the end of March? Because a lot of your statements will be based on this. So you can see in the 3-month period here of how dramatic the drawdowns have been since then. But I'll just go through the annual figures. So the JSE is now down 18.5%. The old bond index is only barely down 3%. There's been an absolute capitulation in the SA property index of 48%. And the MSCI global shares is actually a positive figure of 11.6, but you'll see that is the rand depreciation has actually made that gain. And emerging global shares are up 2.3%. Whereas you look at the global shares in dollars, they're still down 21% from their highs around Christmas, and they're still down minus 10%. Emerging markets down minus 23 in the quarter, and still down minus 17.5%. So quite a lot of value. And South Africa, never forget this, South Africa is seen, first of all, to global investors as an emerging market. And when they turn positive on emerging markets, they turn positive on the rand, and they turn positive on South African shares. Now, I want to bring you back to the first graph that I showed you about how things are priced. Now, how things are priced in March. So just to stand back a little bit, the dark blue lines are the 1st of January figures. The light blue lines are the 31st of March, 2020. Just in general, you'll see that we had a problem in that in January that most things looked pretty expensive. Now we're starting to get excited that a lot of the asset classes with a 10-year view are actually looking quite cheap. So if you look at South African equity, which was looking slightly overpriced, it's now looking very, very cheap. The bond index with the downgrade is looking quite cheap. Property has blown out completely, and it's a very dangerous place to invest now because you don't know which companies might actually go under and might not survive this crisis. Global equities, the broad index, is down now and looking attractive at probably an 11 or 12% return. Emerging markets, who were cheap, have got even cheaper again. And here's the interesting one. The US, which we were worried about, has come off. It actually probably went down to zero, but has been bought back up again. So what they are anticipating in the States is that this is a short-term dip, and they have bought into the stimulus package, and those stocks have rebounded very, very quickly. So it does look like right now that we are not excited about US equities at the moment. We're going to have to watch this coronavirus story to see are they actually right to say that this is a short-term issue. UK equities, who were at zero the last time in January, are now looking fully priced. The European equities cheaper, and Japanese even cheaper. Interesting, global property has also lost out, and it's now starting to come into a buy territory from being quite expensive. Here is the most extreme version, and kind of getting into bubble territory, is that we were worried that the G7 bond market was very expensive, and has got even more expensive because of reduced interest rates. Interestingly, and this would affect South Africa, is that emerging market bonds have become even cheaper and starting to look very attractive at very high yields. So in general, you can see that if you have a 10-year view of your investments, you're actually seeing that many of the assets are actually looking in buying territory. And the two things that look maybe slightly worrying are US equity and the developed market bond market. So what has happened? If we look at the Fed, or the Federal Reserve in the United States, as a proxy for all reserve banks around the world, they have all been proactive. They've all learned their lesson from the global financial crisis in 2008 and 9, and those that acted swiftly and aggressively came out of that crisis the best. So all of them have acted very quickly. The first thing they all did was to reduce interest rates. But the global players, you'll see in a minute, they don't have much to play with. Their interest rates are so low. So they reduced interest rates. Then they came into the market, which is called quantitative easing. And what they're doing there is they're creating liquidity in the market to make sure that the market, there are always buyers when somebody wants to sell something. So there aren't distressed sellers like we had in my property analogy earlier on. The third thing that they've done is they have announced the biggest rescue package ever of $2.3 trillion to help business survive this. So this is a different crisis to 2008, where it was about the banks. This time, and I think one of the economists, I think it was Kevin Lings from Standard Bank, said their job now across the globe is to make sure that when people go back to work, there actually will be businesses in place. So they have to make sure that businesses stay in business. And that's what those packages are about. The crisis is making China a stronger player. China and America are competing against each other to be the world power economically, and China is just slowly eating up, and this crisis is going to weaken America more and make China an even stronger player. Just when you didn't need it, OPEC had a big argument. So the Saudis had an argument with the Russians, and to teach them a lesson, they dropped the oil price from $60 down to $20. That's recovered, it's up to around $30 now. The interesting one for the US is that the US was oil-wise or energy-wise self-sufficient with fracking when the oil price is at 60. It now isn't anymore. So there might be a second issue at play there. Keeping liquidity, keeping markets going is where the reserve banks are all having to play a role, and that has happened here as well in South Africa. The one thing that is strong this time, which is different to the 2008, is that the banks are fine in the offshore. They are, the regulation has worked, they're all well funded, and they haven't overextended themselves this time. But it's now about general business. So we put Superman over the US dollar, and really the only winner through this has been the US dollar. It's strengthened. They probably will have a problem. It's probably a bit too strong for them now when things normalize and people want to trade. They'll need that currency to weaken again. In South Africa, in January, as I said, we were worried about, Eskom and the SOEs, and we were looking, going, how can we get growth, which looked difficult in itself. Now it's Plan B, and Plan B is survival. Some political players call it, they're at war now. We're at war, and we have to win the war, so we have to throw everything at it. And the Reserve Bank of South Africa, which is a very conservative organization and is notorious at moving quite slowly, dropped interest rates by 100 points or 1%, which was a big move for them. It is widely expected. Every single commentator has told us that they are expected to drop it by another percent. And in fact, the Old Mutual person yesterday said that they think it'll come down by 2 points eventually over the next 6 months to help the economy. The other thing that they did was the Thursday before the lockdown, you would have heard an announcement on the radio that the Reserve Bank was going to step into the secondary bond market. Basically what happened was there were no buyers. There was no buyer of the house. There were no buyers of the bonds. And they stepped in to create that market as active bond managers were selling South African bonds. Being a South African at the moment with basically that's the man on the ground with the bear over it. It's a bit of a gruesome picture, but it does feel like most Fridays we do get a bit of a kicking while we're lying on the ground with the downgrades. Moody's there were 1 or 2 people that told us they didn't think it would happen now, and maybe it'd be in November, but the shock with Moody's was that they said, we're not only downgrading you, but we're also putting you in a negative watch, which means that the next time they come out, they might actually drop us down a division. So in the bond market, credit ratings, you can be in Division 1, where we were, and you can be in different places in Division 1, but it's a good place to be. We've been now put into Division 2 by Moody's and the others, and Fitch announced the other day, last Friday, that they are putting us in Division 3. and when S&P report, they will put us in Division 3, and Moody's have warned that they might do so as well. But we'll show you that that has actually been priced into the market, which we were quite comfortable with. Retail in South Africa, tourism in South Africa, in real trouble, and this downgrade this lockdown is a real problem for those industries, and when they will be able to unlock, we don't really know. And the other real problem is commercial property and what's going to happen there. But you might find that there might be some socialistic solution to this in the end. So South Africa is in a quandary. It's back firmly up against the wall. But maybe that's when South Africa is normally at its best. And we'll come back to this later on. So this is just to give you a sense of how interest rates have actually come down around the world. I'm just going to jump down to the pink line. The pink line is the European, what you get. If you put your money in the money market in Switzerland, you put €100 in, they'll give you back 98 or 99 euro next year. So they are trying to encourage people not to leave money in the bank and rather put it into risk assets. In America now, they have dropped. They've started, this is this broken line. They started to drop interest. So they started to increase or normalize interest rates. And then Trump needed to, for the election, and they brought interest rates right down. So if you leave money in the States in a bank this year, next year they will give you the handsome amount of 0.25% in interest in America. Government bond yields globally. Now this is very important just to compare it to where South Africa is. And here is the big one, is America. When it comes down like this, it means that the market is strengthening, but the interest rates that you're going to get are less. So when you buy here, you are buying a government bond for 10 years, and they are going to pay you 0.75 for 10 years. So people are buying this, and that's the rate of return that they're actually happy with, which is quite an extraordinary thing. Or the more extraordinary is that in Germany, the people are actually happy to earn minus 0.5% just to get their money back in 10 years. That is not in any academic book, market book, or economics book. So the governments, the feds, the politicians they're doing their best. It's quite unprecedented that the whole world simultaneously is locked down and will go into recession simultaneously. To just try and explain a little bit about the bond market and the downgrade. So these are all the countries in the world. America is here. It's all priced off America. In the gray box are all the countries that have been downgraded. I'll just move my screen here. And here is South Africa. So if we were priced properly for where we should be priced, we should be down here. So what has actually happened? And we are rated in the same, in fact, Brazil is in Division 3. We've only got one of the rating agencies that put us in Division 3 yet. So you're actually seeing that South Africa, the downgrade has actually been priced in here already. Here's a better way of looking at it. So here you're looking at a line. When the line goes up, it's bad. It means that if we borrow money, we have to, the amount of interest we pay is up at around 13%. Today it's down at 11.5%. Brazil, which is rated below us in the open market, are paying less than 8% interest. So it's actually showing that this line, and asset managers are actually buying these now because they're saying we can't get a 12% return guaranteed for the next 10 years. So a lot of people, asset managers, are buying this to put it in their pocket and save it for the next 10 years. And here we are. So we talk about inflation. So we always plan that inflation is 6. Currently it's down at what is that, 4.5%, and it's probably going to go lower with the lower oil price. But here is the gap. So that is what we would normally hope to get, 6 and 12. That is what we would hope to get from an equity type portfolio. And now we're getting it from a government bond. And what Fitch did say is South Africa will not default. Government, they do not expect that. That risk is not there. So how cheap is the global market and how cheap is South Africa now? And this is what's called a PE ratio, and it gives you a sense. So when it is high, it means that it is expensive. And when it goes low, it means that it is cheap. So the green line is the world share index, the MSCI world index. And you can see it tracking up here, went up to around 17, which is fairly expensive. And now it is down at probably around 12.5%. South Africa last year was trading in and around 13 or 14, and it is now down at 8. So it's just showing you on a very crude version of how cheap South Africa actually is. And then on to the Rand and what will become of the Rand. Now here's the silly thing about the Rand. This red line is showing you what the Rand should be priced at all the time. You will notice it's like a naughty child. It never ever hangs around at this level. So when this broken line shows when the Rand is 15% below or 15% strong, and the broken line above it shows when the Rand is 15% weak. Okay, so here was the crisis with Thabo and Mbeki back in 2001 when the Rand blew out properly. Here is the 2008-2009 crisis where emerging markets, and they pull money out of emerging markets. Here was Nene Gate. And here, in actual fact, this graph is out of date. Actually, the graph was on Friday evening, the graph was actually up here. The graph today is back at around 18, or the line is back at around 18. I do want to point out one thing. So the Rand never is at full value or fair value. They believe that the Rand is fair value is around 14, sorry. But I just want to point out when the Rand does blow out, look at what happens typically what happens afterwards. So we believe, and every commentator that we've spoken to believes that the Rand is underpriced at the moment, and the Rand is going to appreciate from these levels. So what does all this mean? How has this affected us? Everyone listening to this has a different portfolios with us, and they're targeting different rates of returns. So just to give you a sense over a 12-month period, kind of what has happened for people who are targeting CPI plus 2. Well, they've got a minus 5.5% return. People who are targeting CPI plus 4 have got a minus 9% return. People who are targeting CPI plus 5, which is effectively a balanced fund, are getting a return of around minus 13. A global balanced portfolio in Rands is plus 12%, let's call it. The same portfolio in dollars is minus 12. So that shows how much the Rand has weakened and cushioned these returns. Global equity has given, in Rands, has given an 8% return, but global equity in US dollars is minus 16.5%. So a whole array of performances, a Rand strengthening and nothing else moves means that those numbers, those positive numbers you're seeing for global balance and global equity and Rands, those numbers will be suppressed by a strengthening Rand. Just to give you a bigger picture of the kind of flagship funds in the industry in South Africa over 12 months. So Coronation have done a minus 12%. Prudential, who had the biggest holding of Sasol in the industry, is down minus 17. Allen Gray is down minus 14. Old Mutual Wealth's SIS fund is down minus 13. Resco has been the best performing fund in the industry. Has given an amazing plus 9.5% return. They said that they are about capital preservation first. They have disappointed us in the past when the markets were rocking and they didn't like what they saw, they stayed defensive and sometimes you can lose out. So Investec Opportunity, which buys quality offshore stocks primarily, has given a 1% return, and Investec Managed, and she was very negative last year, Gail Boone, and she's given a plus 7% return. And just to give you a sense, PSG, a very big firm in the country, has given a minus 28%. And really what you're seeing is Prudential, Coronation, PSG, and Alan Gray actually, the companies that were getting positive on South Africa last year are the ones that have been punished the most. But it might also mean that there's the most value within those funds right now. Offshore exposure, we've used a couple of flexible funds. Coronation Optimum Fund has given a 13.5% positive return. Forward Flexible, because of the rand appreciation, has given a 4% positive return. And then the direct offshore in dollars, just to give you a couple of big names, Orbis are minus 16, Ned Group Global Flexible, which is also a value manager, is minus 14. The Ned Group Core Global, which is a passive version of that, minus 7. And that's been what's really helped that is the stimulus packages. And then Investec Global Manage is also minus 16.5%. So it's just to give you a sense of that. So that's a lot of information, and you're probably asking yourself, so how does that affect me, and how are we going to deal with this? So what you're picking up is that all of these asset managers, to go back to my property analogy, are driving around now, and they are looking in different suburbs, and they're looking for distressed sellers, and they're looking at the properties that they do hold, and they're looking at where they will go to next. And see if they could actually get something that's going to give them a better return in the next 10 years. So how does it affect you or me? So asset prices, what you need to know is you're going to start getting statements over the next couple of weeks, a month or so, for the end of the 31st of March. So this is really giving you a heads up that the asset prices are going to be down and the investment returns are going to be negative. If you are a delicate investor or feeling a bit down, I wouldn't look at I wouldn't look at the values myself. I'm certainly not going to look at it because it's not going to help me. I know in general how it's looking now, and I know that the asset managers are working feverishly behind the scenes to rectify the situation. We will return to the financial plan. We'll go back to the financial planning process that we've always done because we believe that this is the right way to get us through these times. What we will do is we'll take out the model again. We'll put in these lower values, even though we know they're very low values, and we're quite confident that they will come back over time. We will put in your current expenses and your future expenses. And what that is going to tell us is that, are we in the right investment strategy? Are we in the right funds? Have we got the right mandate for you? Or do you need to actually target a higher rate of return to meet your lifestyle needs? And what we've found over the years is that there aren't major tweaks that need to happen. Now, there are things that you can control, and there are going to be a number of trade-offs in these meetings while these asset prices remain low. The first is that if you can defer or you can reduce your spending for the time being, that would be very helpful. For those of you who are considering retiring in the next year or two, and we'll work this through the scenarios, we'll play it out, say, well, if you work for 6 months longer, if you work for a year longer, what difference would that actually make? So we found that this modeling process and this financial planning process helps people to actually regain the sense of control after being bumped around in the markets in the last few months. For those of you who have been in conservative portfolios, kind of needlessly been in conservative portfolios, and those of you who've been sitting in a bit of cash, this is a time to walk towards the market, and you should chat to your financial planner about that, because as you can see, everything is pointing to the fact that in the next 10 years we will actually get good returns over time. So these are critical times for investment management for investment managers, and they realize that, and that's why they're so energized and re-looking at everything that they've actually got. And they're also very important times for us as your financial planner. Now, be careful with the amount of news and the news feeds that you're actually watching. You are going to find that the human cost here is just going to keep rising over the next few weeks. And it's quite extraordinary, really extraordinary to me, actually, that yesterday 750 people died in New York City or in and around New York State. And that is where Wall Street is based. And Wall Street has gone up around 10% in the same week, but 750 people are dying every day. That's quite extraordinary. But it just shows you that stock markets are looking elsewhere into the future. The second thing to be aware of is there has never, ever been a time in history, economic history, where economic data is going to be as bad, because never has the world simultaneously locked down. Even in World War II, Asia was still working, America was still working. So you're going to hear the word recession come out now. South Africa will go into recession. We were actually probably in recession before this anyway, and they're talking about it being around minus 3.5%, assuming that we get back to work within the next kind of month or so. And just to give you a sense of this, I'll just move this out of the way if it's in your way. This is a US unemployment numbers. These are the amount of people that sign up for unemployment in the US. And basically the US was at full employment. Technically, there will always be some people that are unemployed. And it was at full employment. Week 1, 3.3 million people signed up for unemployment benefit. Week 2, 6.6 million people. And I think the stats are going to come out today about what's going to happen this week. And the numbers will keep rising, because in the States, they don't hang around. As labor, you don't have much of a choice. You are sent off. So in those figures, you have every bar lady, you have every waitress, you have every builder. All have been, everyone in manufacturing, they've all been let go. But when the market or when the lockdowns end, many of those people will be employed. The problem is we don't know how many will be left unemployed at that point. Will the markets recover? We believe yes, over time. What will that recovery look like? Are we in the middle of a recovery? We don't know. Why don't we know? Because we're dealing with a virus. All the asset management houses have pulled in medical experts, and basically they don't know. The fact that you're watching CNN News and Sky TV and the BBC and the ETV, you know as much as they do at this point. So the high road is that we all get back to work very quickly. I think realistically, we all know that that's not going to happen. It's going to be somewhat of a middle road. South Africa have managed ourselves absolutely brilliantly through this crisis, and we've kept the numbers down spectacularly. Whether they're true or not doesn't really matter. The fact is that our numbers are very, very low. What is likely to happen is businesses like ours will be allowed to go back. Half of us will work at the office, half of us will work at home. There will still be social distancing. We will not be in restaurants. We will not be going to any sporting events. We will not have any arts. We won't be going to any theatres. So all of those types of industries are going to have to wait their time. We won't be opening our borders for tourists until this thing is settled down globally. So that is going to take quite a bit of time. The low road is that the virus keeps coming back. The virus keeps coming in China. It rears again in China. It rears again in South Korea. It rears again in Italy. And the numbers go back to where they are now. And that would be awful and would have significant economic, cause a significant economic crisis globally. So we don't know. It's all about how do we recover. This graph, there are two things to look at here. The first are these bars. These green bars reflect GDP, or how well is the economy actually trading. Okay, now this is back in 2007, 2008, and you're seeing that the GDP figures were very good. They were very good. Then there was no GDP, and then the October came along. Then there was any growth at all. Then it went really negative, more negative again. Still very bad figures, and then you had to wait till the end of 2009 before the economic figures came back up and started to recover. Now, a lot of people wait to see until the data actually proves that the actual recovery is actually there. We wrote an article a couple of weeks ago as actually the market was like slamming down into it felt like the abyss at the time. But here is the blue line is the the stock market, excuse me. And you can actually see, I'm just trying to get my mouse to work again. Just not doing. So at the bottom of that in 2009, you actually see in June 2009 that the market bottomed out. And to use the analogy that we used in that article, somebody guessed or somebody saw a bird with a leaf in its mouth. And they knew, even though the economic data got worse again the quarter after and was bad for another 6 months, it was only 9 months later that they could actually wait for the news. But if you wait that long, you will miss 50% of the recovery that's actually happening. So in South Africa, I think we learned this through the rugby as well. When South Africa's backs are against the wall, we're actually at our best. And the ANC is an organization that is just such a broad church. You can't really get much done as a result of that. But the ground is now fertile, perfectly fertile for there to be a social compact of some sort, so that business, labor, and government can get into a room, put it on the table, not what they want, but what they can offer and what they could do to actually improve the situation, and rather than somebody sitting there with their arms folded and saying, this is what I want out of it, or no, this isn't going to work for us. So there has to be some sort of social compact at this point. The other thing to realize is that South African businesses, the big businesses, are actually sitting on a huge amount of cash, and it's sitting in money market. They haven't allocated it. Some went offshore with it, and it's been a disaster. So they won't be as quick to take that money offshore next time. So that money is ready to be allocated into new projects, but they have been too afraid of the government and of the policies that government have been messing around with. So they need that, in that social compact, they actually need a little bit more certainty. The downgrade has also shifted the power possibly over to Tito Mboweni, and that's the right of the ANC. And they can kind of now turn around and say, I told you so, to everybody else. And now they have to get on with it. And now they can use this crisis under the guise of this crisis of the pandemic. They can actually be much more decisive in what they're going to try and do. And the one thing that struck me watching all of the ministers reporting back every evening is that you just got the sense, well, first of all, I think Ramaphosa has been amazing. I think he's handled this perfectly. I think he has grown in stature. You can actually physically see it. I think the way in which he dealt with the communications minister for going out to lunch was also a very good move and a very strong statement to everybody. But when you look at all these ministers, I think it's the first time in many of their careers that they actually realize what it is to lead a country. And maybe it could be this crisis could be a bit of a catalyst for them to actually wake up a little bit. So thank you very much for listening in. Sorry, it's a huge amount of information, but a huge amount has happened. We would love to get your feedback on it. And just to say, I'm very proud of you, as our clients. We have had very few phone calls of people panicked and people worried. There are obviously some people that would phone, and that's fine, and that's what we're there for. And we would encourage you, if you are, to contact us. But I'm also very proud of the job. We know that this is an important moment for the asset managers to do their job. It's also a very important moment for us as your financial planners to help you through this crisis and not to allow people to capitulate. And I'm really proud of the work that Claire, Rick, and Laura have done with you over the last few months. So have a great weekend. We'd love to get some feedback on this to see how well it worked or how badly it worked. We wish you, for those of you who celebrate Easter, a very happy and a holy Easter. And be careful out there and take care of yourselves. Thank you.